Right, let's get back to Neeraj Seth of BlackRock, and also, just before we do that, let's get a good conversation flowing and bring in our guest host, Ray Faris, Chief Investment Officer for South Asia at Credit Suisse. Ray, very good morning to you.
Good morning.
The case for bonds, how strong is it or otherwise, given the fact that they have come off, yields have come off their lows now?
Well, we don't see a lot of value in bonds, especially government bonds globally, for the simple reason that the valuations, as you noted, are still really very rich. We don't see a recession coming. We think the Fed's going to cut rates, not just once, but twice between now and the end of the year. And that should give the U.S. a bit of an extra kicker, especially through the mortgage market, re-steepen the curve and take 10-year Treasury yields, we think, back up to about 1.8% to 2%.
Can I just follow up on that? Because yield curve re-steepening, good news for the banks. Do we get back in?
That's a good point. We do like financials. It's one of the two sectors in the United States, along with IT, that we think should do well. Based on this idea that the Fed's going to cut rates, the economy won't go into a recession, and we should get some re-steepening in the curve, higher yields.
Ray, I just want to get you to weigh in here on what we were talking about with Neeraj earlier and the repo operations the Fed conducted overnight. They're going to do another one this morning as well. Neeraj was of the opinion that there won't be quantitative easing or bond purchases restarted as a result of this. I mean, what's your view?
The repo rate issue?
Yes.
Yeah, this is a really good point. One of my colleagues in New York, Zoltan Pozar, has been writing about this literally for the last year or so. A lot of what people perceive to be excess reserves have essentially been taken up through either regulatory changes that require banks to maintain liquidity through the day, but particularly through foreign central banks being able to access the Fed's reverse repo facility. They've sterilized, in essence, they've locked up a lot of reserves. The Fed so far seems unwilling to cap that facility, to try to kick foreign central banks out. The implication is quite simply that they're going to have to cut rates more. So they injected liquidity overnight. They said that they've stand ready to inject more liquidity, but we think ultimately they're going to need to lower rates. Are we ready for QE? Probably not. They'll probably adjust to a variety of other facilities, and they'll probably use rate cuts for the time being. But they definitely have a specific money market plumbing problem. This is about the technicalities of the money market, regulatory changes that require banks to hold more liquidity through the course of the day, and of course this issue with foreign central banks having essentially sterilized a lot of U.S. reserves.
And Neeraj, would you agree that further cutting of rates will help that plumbing problem, so to speak?
I think cutting rates is part of the equation. They'll have to obviously figure out the liquidity requirements of the system, and hence obviously the OMO that they came back to the market with. So a combination of the two is what they will probably keep doing, bringing rates lower and probably doing more OMO to actually solve the issue in the near term.
Yeah, that's right. They're going to have to do several different things. It's going to be a combination.
If it is a hawkish cut, then does that fuel this persistent strength in the US dollar, Neeraj, and where does it leave the case for local currency bonds out here?
So first of all, if it's a hawkish cut, it does obviously push the dollar higher. So if you look in relative terms, with the rest of developed markets, obviously you got ECB, you have BOJ, everybody on the easing path. Dollar is already strong on a trade-weighted basis if you look at the last couple of decades. So a stronger dollar obviously will have impact on the emerging markets and will have pressure on the local markets here. So I would say temporarily, at least for now, makes you cautious about the local markets in this part of the world.
Do you agree?
We would agree. I mean, if the Fed is going to be hawkish against the background of the ECB having just eased and the BOJ signaling that it might also join the party, then yeah, the dollar is going to strengthen. The other aspect of that would be markets think that we need larger cuts. If we don't get larger cuts, markets are going to be concerned about growth, which will be a risk-off trade, will push people into safe haven type of currencies, and that's really right now, that's going to be the dollar.
We're a couple of weeks away from US earnings season, so is the persistently strong US dollar going to be something of a wrecking ball for those companies in the S&P, about half of them, right, that have international exposure?
It's certainly a bit of a drag. There is a large chunk of U.S. earnings, not the majority, that comes from foreign activities and foreign profits. But I think the bigger issue for U.S. corporates and U.S. earnings is really just simply growth. The fact that growth outside the United States has slowed so substantially. China, Europe, really pretty much everywhere except for the U.S. The U.S. has weakened a bit in the third quarter, but it's still a standout globally.
Does it also reduce some of the room to maneuver for central banks in this part of the world in emerging markets if the Fed is going to be more hawkish, and then there go all those hopes that the central banks are going to be able to offset some of that slower growth? That's
right. I mean, you would see that, I think, largely in the current account deficit countries. So India, Indonesia, if the Fed's hawkish and the dollar strengthens meaningfully, then the weakness in those currencies that would just come as a byproduct would limit the extent to which they could cut rates. But I want to stress, it seems extremely unlikely that the Fed is going to be hawkish. Everything that's come out of the chairman, the vice chairman, and the New York Fed president, essentially the triumvirate of the Fed, has been about supporting the expansion, about doing what's necessary to support the expansion. So they'll probably cut, and they'll probably want to try to make clear to markets that they are going to be watching data and will be data dependent. But I don't think that they're going to take away this signal of a willingness to cut if necessary, that is this language about supporting the expansion.
Right. I mean, it does seem, why would they at this stage, right? Ray, Neeraj, stay with us. We'll have much more to discuss coming up after this break. We are off just for a quick break. We'll see you in a few minutes. Welcome back to Squawk Box. We are still standing by with Ray Faris of Credit Suisse, our guest host, and Neeraj Seth of BlackRock. Neeraj, I just want to get to you because we've kind of laid the backdrop here with what's going on in monetary policy globally, and how does it affect your view of credit in Asia? I mean, what do you consider an attractive investment at this stage?
So overall, I would say very much in line with whatever we've covered in the past. Quality carry is going to still be in demand. I think we live in a world where there's not enough good quality fixed income. Ray touched on it. Obviously, a lot of the government bonds, close to 15 or 16 trillion, is trading in negative yield territory. We are in a different world altogether. Demographics are what they are. There's demand for income. So the quality carry continues to be in demand. Within that, more specifically in Asia, we still like parts of investment grade market. We haven't changed our view in a long time. India, Indonesia, parts of China, it's still attractive. Asian high yield has started to look attractive. Now, if we look at the performance of Asian high yield over the course of the year, it has underperformed the US high yield, and the delta has started to become relevant for investors to actually focus on. Now, Asia high yield, by virtue of the market structure and what it is very dependent on China. Biggest part of the high yield market is China, so what happens in Chinese onshore markets, growth policy, the default rates in the onshore bond market, they matter. It should be an important focus, but putting that all together, I would still say Asian high yield is actually attractive.
How would you characterize that default rate, and how do you factor in the risk reward?
So first of all, default rates in the onshore market and offshore market are different. The market structure, there's obviously some commonality in terms of the issuers, but the onshore market default rates, obviously it's more around the access to capital for the corporate sector in China. You've seen uptick since, in fact, if not now, but last year, but it's still somewhat managed in a way that it's not getting out of control. So you haven't seen a significant tightening of the financial conditions, but you've seen an uptick in the default rates onshore. The offshore dollar market default rates in high yield remain relatively stable. They have been in the 1.5% to 2.5% range for the last 3 years. I don't think you will see a significant uptick in the default rates in Asia in the coming next 12 months.
Is it something you worry about, Ray?
I certainly think that Neeraj is right about the situation, the challenge, if you will, for investors. So I would argue that it's even worse than he identified in terms of, say, European markets, where it's not just almost all of the government markets that trade in negative territory, but it's also a large part of the investment-grade corporate universe. So against that background, Asia does have very attractive yields. We like the Asia high yield market. A lot of that focus is on China, and we tend to agree that policy stimulus in China, the easing of monetary conditions through reserve requirement cuts, is going to try to manage that issue. But I guess one thing I would just kind of ask you a bit about, given your specialty, is default rates have been low in aggregate. A lot of people like to refer to sort of 0.5% of the total market. But if you segregate the market between the private companies and the state companies, the differential is sort of 0.5, but for private companies it's 3.4%, much higher. The state's not protecting the private sector as much as it is the state-linked companies. Do you think that'll get worse?
Well, to some extent it does, but gradually. The key is obviously the state, any government for that matter, there's no reason to protect a private company from the standpoint of the balance sheet management. So I don't think that changes. As we get into the later stages of the cycle, the default rate upticks. It does go higher. But when you think on a risk-adjusted basis, on a default-adjusted basis where the high-yield spreads are, you're getting paid for that risk.
Neeraj, we'll wrap it up there, and we want to say thank you to you for joining us as one of our guest hosts, and we'll have more ahead with Ray Faris from Credit Suisse, who stays with us. Plus, how should you be playing the banks as we head into that Fed decision? We'll be back in 2 to discuss that one.
Good morning, Mrs. Wong.
Good morning. Your favorite.
Thank you. Good morning, Mrs. Wong.
Good morning. Look what I made for you.
Thank you. Mrs. Wong? Help! Help!
Good thing your grandson was around when you had your fall, Mrs. Wong.
A little bit of California in every grape.
Everything is tech.
And tech is everywhere.
So join us again this November for East Tech West.
TVC's annual retreat
In Nansha, Guangzhou, China.
Where we host